the motivations for central bank buying, one being the weaponization of the U.S. dollar and the extraterritorial imposition of U.S. will, has been partially responsible for central bank buying of gold. I also believe that the calculus around the U.S. dollar, which we talked about earlier, a currency where they pay you 4.2%, where the real purchasing power of the currency is declining by 7.5%, has also led to the selling of U.S. treasuries and the buying of gold by foreign countries. And when that simple calculus becomes apparent to retail on a global basis, then I think you see a real precious metals bull market. When you see continued central bank buying, continued official sector buying, and you see net inflows to the gold ETFs, then the market gets legs. Of course, everybody wants to ask an old man like me when that's going to occur. And an old man that's been on Earth as long as I have has the good sense not to answer that question. Because the truth of the matter is, I don't, nor does anyone else. No, the market was behind itself. Chris, when people say, Rick, when are the metals price going to move, in particular the gold price, I say, I think they're going to move in 2000. In 2000, gold was $253 an ounce. Now it's $2,700. It's moved at 8% compounded for 24 years. This year was just playing catch up. That's all it was about. Really, nothing has changed, Chris. The market share of precious metals and precious metals related assets in the United States relative to other savings and investment classes is only 0.5%, which is to say less than 0.5% of total savings and investment assets in the United States is denominated in precious metals and precious metals related assets. The 4-decade mean is 2%. The gold bugs say, the treasury market's going to implode, the dollar's going to go to zero, gold is going to replace US dollars. That's all horseshit. And it doesn't have to happen. If the market share of precious metals reverts to mean, which is what I think is going to happen, and I think it's going to happen over the next 5 years, demand for the stuff increases fourfold. Fourfold. Now, people ask me for price targets. I have no earthly idea. And I couldn't care less about information that's irrelevant. All I can say is if demand increases fourfold, it's going to have an impact on price. I can also say, in direct answer to your question, I don't know why, but in prior gold bull markets, the market has been led by gold. At a certain point, when gold establishes the momentum and the generalist investor buys the precious metal narrative, leadership switches to silver, and silver rises further and faster than gold. When will that occur? I have no earthly idea. Will it occur? I'm 100% confident that it will. Well, I'm 71 years of age now. I'm a very healthy 71-year-old. I think I'll be graced with many more years on Earth. And I think the U.S. dollar will be the world's reserve currency for the rest of my life. I think the hegemony of the U.S. dollar will be called into question because of the idiotic imposition of U.S. policies, the weaponization of the U.S. currency. But I think, to quote Doug Casey, the dollar is the worst currency in the world, with the sole exception of all the others. Yeah. So I think the dollar will continue to do well if you measure it against other fiat currencies, which will do less well. But I think for Americans, or for foreigners who have chosen to denominate their lives in U.S. dollars, that the maintenance of purchasing power in the U.S. dollar will increasingly be challenged, not relative to the maintenance of purchasing power in Canadian dollars or euros, but in an absolute sense.
Rick Rule's insights into gold and silver often strike a balance between deep market expertise and the common-sense realities of investing. Let's dive into what makes these precious metals a cornerstone of wealth preservation and why their value narrative has stood the test of time. Rick Rule sets the stage by reminding us that gold, since 2000, has risen from $253 per ounce to its current levels near $2,700. This represents an annual compounded return of 8%, a figure that is remarkably consistent when compared to the erratic nature of other asset classes. For those wondering when gold's price will move, the answer is, it already has. The question now is not whether gold will move, but how much further it will go in response to growing global economic imbalances. What's fascinating is that this growth isn't about gold rising in value, but about the US dollar losing purchasing power. As Rule points out, gold's role has always been to maintain wealth, not to generate speculative returns. When you hold gold, you're not betting on a price increase. You're ensuring that the value of your savings doesn't erode amid inflationary pressures. The narrative around inflation often hinges on the Consumer Price Index, CP1. But as Rick Rule notes, this metric is largely a fiction. While the official CPI figures hover around 2.5%, the real-world cost of living tells a very different story. Gasoline prices, healthcare costs, and grocery bills paint a picture of inflation closer to 7.5% annually. For anyone keeping track of their monthly expenses, this discrepancy between official inflation and lived reality is glaring. This misalignment is where gold and silver come into play. They act as a hedge not against the CPI, but against the actual erosion of purchasing power. By holding these metals, you're effectively sidestepping the hidden tax of inflation that eats away at fiat currency savings. One of the most striking observations Rule makes is that precious metals and related assets account for less than 0.5% of total U.S. savings and investment assets. Historically, this figure has hovered around 2%. If market dynamics revert to the mean, and there's every reason to believe they will, demand for gold and silver could quadruple. Such a shift would have profound implications for prices, even without the apocalyptic scenarios often touted by extreme gold bugs. Historically, gold leads precious metals bull markets. Once gold establishes momentum and attracts generalist investors, leadership often shifts to silver. Why? Silver's affordability and higher volatility make it attractive to retail investors and speculators alike. When this transition occurs, silver typically outperforms gold, rising further and faster. However, predicting when this shift will happen is nearly impossible. What's certain is that it has occurred in every previous bull market, and there's little reason to doubt it will happen again. For investors with the patience to hold through the inevitable ups and downs, the rewards could be spectacular. Rule also touches on the US dollar's position as the world's reserve currency. Despite challenges, including the weaponization of the dollar and its declining purchasing power, the dollar remains the worst currency in the world, except for all the others. This relative strength is cold comfort for Americans, whose savings are eroding in real terms. But it underscores the importance of diversifying into assets like gold and silver that offer stability in an unstable world. Central banks have been the quiet but consistent buyers of gold, a trend that underscores its role as a strategic asset. These institutions aren't interested in speculative gains. They're hedging against systemic risks and diversifying away from the US dollar. The same logic applies to individual investors, who would do well to follow the lead of these sophisticated market participants. Unlike gold, silver hasn't seen significant buying from central banks. This lack of institutional demand explains why silver hasn't moved in tandem with gold. However, this disparity presents an opportunity. As gold continues to rise and retail investors re-enter the market, silver is likely to follow, offering outsized returns for those willing to take the plunge. Rick Rule's perspective on gold and silver is refreshingly pragmatic. He doesn't rely on doomsday scenarios to make his case. Instead, he focuses on historical trends, market fundamentals, and the arithmetic realities of inflation and currency devaluation. For investors, the takeaway is clear. Gold and silver are not just hedges against uncertainty, but essential components of a balanced portfolio. While the timing of market shifts is uncertain, the long-term value proposition of these metals is not.
And I think it's important for your listeners to understand the reasons why, with the caveat that it might be boring. It's arithmetic, not narrative. The measurement that people use in terms of the deterioration of the purchasing power of the US dollar is the CPI. That's the stated rate of inflation. And it's fiction. It's absolute fiction. They suggest to you that CPI as a measure of inflation, and maybe it is defined inflation, but it's no measure of the decline in purchasing power. Your listeners need to ask themselves, in the last 4 years, since 2000, where the CPI stated rate of inflation has varied between 2.4 and 2.7%. So let's call it 2.5% compounded. What's happened to the price of gasoline in 4 years? How about healthcare and health insurance? Mortgage interest rates have doubled. The price of groceries is a political issue. And of course, the CPI doesn't include tax. Have your taxes gone up in 4 years, Chris?
Yes.
I would suggest to you that for the basket of goods and services consumed by Chris Marcus or Rick Rule, that the purchasing power of the US dollar is declining by about 7.5% compounded. Here's the crux for the dollar. If they're paying you 4.2 in the US 10-year Treasury, in a currency that's declining by 7.5% a year, your savings are costing you. It is in circumstances, over time, where investors are concerned about the maintenance of their purchasing power in fiat instruments, that gold does well.
Yeah.
If you look at the period 2000 to 2024, gold has kept pace with the deterioration of the purchasing power of the US dollar. One could say that gold isn't up from 253 to 2700. One could say that gold hasn't increased in price sevenfold, but rather that the dollar has deteriorated in terms of purchasing power sevenfold. And I think what you saw this year is the beginning of the realization, just the beginning of the realization of that calculus. The strength in gold is not retail strength. The retail has not been buying it. The central banks have been buying it. If you measure popular sentiment around gold with cash inflows to the ETFs, you only saw 5 months of positive flow into ETFs. Right now you're selling retail selling of gold and retail selling of silver. Why did gold respond and silver not? Well, that's simple. Central banks buy gold. With the exception of stated intentions by the Russians, central banks don't buy silver. So a market that moves as a consequence of the participation of one buyer probably doesn't move in a sector where that buyer isn't focused. I believe that the motivations for central bank buying, one being the weaponization of the US dollar and the extraterritorial imposition of US will, has been partially responsible for central bank buying of gold. I also believe that the calculus around the US dollar, which we talked about earlier, a currency where they pay you 4.2%, where the real purchasing power of the currency is declining by 7.5%, has also led to the selling of U.S. treasuries and the buying of gold by foreign countries. And when that simple calculus becomes apparent to retail on a global basis, then I think you see a real precious metals bull market. When you see continued central bank buying, continued official sector buying, and you see net inflows to the gold ETFs, then the market gets legs. Of course, everybody wants to ask an old man like me when that's going to occur. And an old man that's been on Earth as long as I have has the good sense not to answer that question. Because the truth of the matter is, I don't, nor does anyone else know.
The strength in gold today is not driven by the usual retail frenzy. Instead, it is a calculated move by central banks. These institutions, with their massive reserves and long-term outlook, are hedging against systemic risks in the global economy. The ongoing accumulation of gold by central banks like those of China and Russia reflects a broader shift away from the dollar-dominated financial system. Central banks are sending a clear signal. They anticipate significant volatility in fiat currencies. The weaponization of the US dollar through sanctions and extraterritorial policies has eroded trust in its reliability. Nations previously content with holding dollar-denominated assets are now rethinking their strategies, choosing gold as a safer and more independent alternative. For retail investors, the takeaway is simple, yet profound. If institutions with access to the best financial intelligence are stockpiling gold, it makes sense for individuals to follow their lead. Gold is not just a hedge, it's a vote of confidence in enduring value. While gold often grabs headlines, silver offers a unique investment proposition. Historically, silver has been the people's currency, accessible, versatile, and indispensable in both industrial and monetary contexts. Yet it remains undervalued relative to gold, a disparity that savvy investors can exploit. Rick Rule highlights a critical aspect of silver's market behavior. It often lags gold in the early stages of a bull market. However, once gold establishes momentum and gains the attention of generalist investors, silver typically outperforms. This is due to its higher volatility and lower entry price, which attract retail buyers and speculators alike. Consider this. In past bull markets, silver has delivered returns that far outpace gold. During the 1970s, for instance, silver prices surged by over 1,000%. Investors who had the patience to hold through the initial quiet phase were handsomely rewarded. The current market setup suggests we may be on the verge of another such opportunity. For those looking to amplify their exposure to silver, equities in the sector present a compelling option. The historical performance of quality silver mining stocks is nothing short of extraordinary. Rick Rule recounts how companies like Pan American Silver and Silver Standard saw their share prices soar from mere cents to over $40 during previous bull markets. The caveat, of course, is that these investments come with significant risk. Mining stocks are notoriously volatile, and their fortunes are tied not only to the price of silver, but also to operational factors and geopolitical risks. However, for investors with the stomach for volatility and a long-term horizon, the potential upside is unparalleled. Geopolitics has always played a role in the demand for gold, but its importance has grown significantly in recent years. The U.S.'s aggressive use of sanctions and control over the global financial system has pushed countries like Russia and China to seek alternatives. Gold, with its universal acceptance and lack of counterparty risk, fits the bill perfectly. China's strategy, in particular, is worth noting. The country has been quietly accumulating gold while simultaneously reducing its reliance on U.S. treasuries. This dual approach strengthens its financial position and reduces its vulnerability to economic coercion. Other nations, observing China's moves, are likely to follow suit, creating a virtuous cycle of demand. Silver, while less central to these geopolitical calculations, stands to benefit indirectly. As nations diversify their reserves into tangible assets, the monetary role of silver may regain prominence. Additionally, silver's industrial applications make it a critical resource in an increasingly technology-driven world. One of the more puzzling aspects of the current market is the lack of retail participation in gold and silver. ETF inflows, often a proxy for retail sentiment, have been muted or even negative in recent months. This stands in stark contrast to the robust demand from central banks and institutional players. This disconnect presents an opportunity. Retail investors, influenced by short-term trends and market sentiment, often arrive late to the party. For those willing to act contrarian and buy when sentiment is low, the rewards can be substantial. Once retail investors re-enter the market, they will add a new layer of demand, driving prices higher. Beyond its monetary appeal, silver is indispensable in various industrial applications. From solar panels to electronics, its unique properties make it a critical material in emerging technologies. As the global economy transitions towards renewable energy and advanced manufacturing, demand for silver is set to rise. This industrial demand adds another dimension to silver's investment case. Unlike gold, which is primarily hoarded, a significant portion of silver is consumed. This consumption creates a structural deficit in the market, further tightening supply and supporting higher prices. Inflation remains one of the most compelling reasons to own gold and silver. As Rick Rule explains, the official inflation metrics often understate the true erosion of purchasing power. Real-world inflation, as experienced by everyday consumers, is significantly higher than the 2 to 3% figures often cited by governments. In this environment, gold and silver serve as effective hedges. They offer a way to preserve wealth and maintain purchasing power, even as fiat currencies lose value. The longer inflation persists, the stronger the case for these metals becomes. Precious metals have been a store of value for thousands of years. While modern financial systems have introduced new asset classes, the fundamental appeal of gold and silver remains unchanged. They are immune to default risk, independent of any government or institution, and universally recognized as valuable. Rick Rule's investment philosophy emphasizes this long-term perspective. He advises investors to view gold and silver not as speculative trades, but as foundational elements of a resilient portfolio. This approach requires patience and discipline, but offers unmatched stability in an uncertain world. Timing the market is always a challenge, but understanding sentiment can provide valuable clues. Precious metals markets are often driven by fear and greed. During periods of economic uncertainty or financial instability, gold and silver attract fear-driven buyers. Conversely, during bull markets, greed takes over, driving prices to euphoric heights. Recognizing where we are in this cycle can help investors make informed decisions. Currently, we appear to be in the early stages of a long-term uptrend. Institutional buying is setting the foundation, and retail participation will likely follow. For those willing to act now, the potential rewards are significant. Gold and silver are more than just commodities. They are strategic assets with the power to protect and grow wealth. In a world of rising inflation, geopolitical tensions, and declining trust in fiat currencies, their value proposition has never been clearer. For investors, the key is to take a long-term view. As Rick Rule often emphasizes, precious metals are not about chasing quick gains, but about ensuring financial resilience. By understanding the dynamics outlined here and positioning yourself accordingly, you can capitalize on what promises to be a transformative era for gold and silver.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.